Dankeschön, Dr. Lutz-Rattig, and guten Morgen to all. You did say that we had to thank the snow for not falling in Frankfurt and allowing me to actually land in your great airport when it's opened. I know you had a few problems earlier last week. I have to say, Dr. Rattig, and I thank you very much for inviting me, that you owe as much to the snow as you owe to Mr. Weidmann, President Weidmann, Professor Weidmann. I'm short of title, actually, for you. I will call him Jens, on account of shared studies in Aix-en-Provence many years back when we were young. But I had actually promised him that I would come for this particular event, and I try to deliver on promises that I make. Your summit this year examines how regulation and crisis management will change the world's financial landscape. Now, I'm sure all of you will be absolutely fascinated by the words of wisdom that will come out of my mouth on the occasion of these remarks. But I fear that some of you, maybe not all, but some of you might have some interest in other matters that are on the agenda at the moment. So in order to satisfy that interest, I thought I would just say a few words about the current situation. And given the privacy of this room and the total confidentiality that I'm sure will be kept, I will mind my words. Obviously, this is not the topic of the day, and we're going to dwell into the financial reforms and the second part of my address to you, which has to do with the necessary balance sheet review and banking union in Europe, which will be in and of itself an important topic. But I would just like to reiterate, as Managing Director of the IMF, that we welcome the agreement reached to address Cyprus's economic challenges. The IMF has always said that we would support a solution that addresses upfront the core problem of the banking system through a clear strategy. A solution that is sustainable, and in that regard, the debt sustainability analysis was particularly important, and that is fully financed. Now, there is one particular aspect that goes totally unnoticed at the moment, because there is essential talks about tax here and tax there, and who is taxed and at what rate. But there is clearly also, as part of the political agreement that was reached amongst members of the Eurogroup, a particular focus on the restructuring of the banking sector in Cyprus. And while not with immediate effect, as a bail-in would have been, it is still very much a centerpiece of the agreement that was reached, that the banks would have to right-size and restructure properly in order to make the whole business model sustainable going forward. And that aspect of the bank and banking sector restructuring, for the moment, has not been commented upon. So I thought I would just underline, for those of you who care to report outside this room, that this was part and parcel of the agreement. We are also, obviously, extremely supportive of the Cypriot authorities' intentions to introduce more progressive rates in the one-off levy or deposit share swap within the agreed financial envelope of 5.8 billion. So overall, and with this particular emphasis that I've just put on the banking sector and the banks restructuring, I believe that the agreed approach meets these objectives, and the authorities will have our full support and cooperation to actually implement, because now is the time for the authorities to deliver on what they have committed. Now, having said that, let me now turn back, so that really sort of deals with any questions that any of you would have had at some stage later on in the day. But let's turn to the topic of the day, which is actually not unrelated to all that, because I believe very much that regulatory reform, the actual proper look at the assessment of balance sheets and banking union within Europe are very much topical in view of the current development. Now, history shows that financial crisis often alter the financial sector landscape. If you look, for instance, at the Asian banks, or if you look at the Nordic countries' banks, you see that after the major crisis that those areas have suffered, the banking sector, the financial sector, were very significantly changed and altered for the better. Question is, has that actually taken place, particularly in the United States of America? And it's quite interesting to actually see that there is only 20 years that have elapsed between the major financial crisis through which the United States have gone, which is, if you remember, the savings and loan crisis back 20 years ago, and the subprime crisis that the United States and then the rest of the world faced in 2007, 2008. And while those two crises were essentially different, both in terms of the depth of the crisis, for probably less interconnectedness 20 years ago, and spillover effects, less so at the time, clearly, yet, you find much of the same ingredients, which have to do with lending policies that were pretty much loose and laxed, and supervision that was not up to scratch. So those were two common denominators of those two crises, 20 years apart, which means probably that not much had been learned as a result of that crisis back 20 years ago. So here we are now, more than 5 years into this crisis, and we can wonder whether the landscape has actually changed significantly or not. In other words, have we built a much stronger system than 5 years ago? My take on it, our take on it at the IMF is not yet. Huge progress has been made. Major changes have taken place, and I'll go through that because I think it needs to be acknowledged, it needs to be reminded, but the whole work is not yet completed. And our job today as policymakers and regulators is to bring about changes that is actually more effective, more permanent, in order to build a more secure and stronger banking system, as well as to try to avoid the repetition of systemic crises that affect the entire community. So what I would like to focus on today is what we believe is needed to bring this about. And I will focus on, first of all, the global regulatory reform and how close are we to solid, sustainable rules. And second, I would like to look at the combined issues which come either together or one after the other. I think that's going to be part of the debate, and probably would have been the debate had my good friend Minister Schäuble been here, is the issue of the balance sheet repair and the banking union reform. So let's turn to the global regulatory reform. I have spent many nuits blanches, and many of my colleagues have as well, because clearly, particularly the European policymakers, but all policymakers and regulators around the world have spent many long nights into trying to actually fix the regulatory environment within which the banking and financial sectors work. And to quote Otto von Bismarck, which I think what he said is true and applies to that, laws are like sausages. It is better not to see them being made. Well, that was pretty much the case during those long nights. But eventually, the sausage making did happen and has produced some historic achievements. Agreements on global bank capital and liquidity regimes that were much more quickly done than under Basel II arrangements. The FSB standards on effective banking supervision and resolution regimes are two major steps forwards that have been taken, some at the Basel Committee, others at the FSB level. And here in Europe, deeper policy commitments have greatly reduced near-term stability risks. But progress is uneven. And that risks undoing some of the achievements. Now, the pace of implementation has been adjusted, in other words, has been slowed down in order to make sure that some of the banks could actually be on the mend and be mended. But delays also reflect difficulties in agreeing on the way forward, and is also due, in parts, to pressure from the industry that is naturally adverse to change of the environment. So let me address some of the key regulatory issues, beginning with bank capital and liquidity. Much has been done on capital rules and liquidity standards, as well as setting capital surcharges and finally agreeing on the list of global SIFIs that would require those surcharges. But we at the IMF are worried about the uneven implementation of these rules, particularly the delay of Basel III in major jurisdictions. Now, when you raise that issue with participants from both the United States and Europe, the US authorities say, okay, we're not implementing exactly on time, but effectively all our rules are there and beyond, and we are actually complying. And then the Europeans will say, actually so much has been done that we are pretty much up to it, up to the levels that are required. Well, then you turn to Japan, and Japan says, we are Basel III compliant. So this unevenness is unnecessary and certainly should be avoided in order to not have the risk of dilution to the overall minimum standards, which can always lie in the background or on the horizon if and when people actually delay the process. In the same vein, it certainly brings a degree of uncertainty that is not needed. The IMF is also worried about something else when it comes to capital rules and liquidity standards. And what we are worried about is the calculation of the riskiness of assets. Now, you know very well what I'm talking about. And it's important because it's the very basis on which you determine the capital needs of all banks and the success of the new rules. I'm sure you know all these calculations and all these model results assessment, but whether it is the UK authorities, whether it is the Basel Committee, whether it is the European banking authorities, they've all found, at respective degrees and percentages, but they've all found significant variations in bank risk weights with similar risk profiles. Now that is worrying. And of course, we live in that interconnected world, and the lowest common denominator at the end of it becomes the interconnection. Now, I don't have a real take on which model is right, whether banks' models, authentic, genuine, homemade, is better than standard, and whether we should just override the models and go for something that is much more standard and probably less fine-tuned and subtle. But there is clearly an issue that needs to be tackled because such variations indicate clearly discrepancy in the assessment. Now that has to do, of course, with accounting. This is an old, not pet talk of mine, but certainly one issue that I've been long concerned about when I was finance minister of France at the time. And I was certainly hoping, finishing my job as finance minister and stepping down, that progress would be accomplished in terms of harmonization and convergence. Well, not sure that that hope was well placed, because clearly the two main accounting bodies, whether it's the International Accounting Standards Board or the US Financial Accounting Standards Board, have not reached agreement yet, despite, I believe, 12 years of efforts, if I recall, on a common approach to asset impairment, that is whether or not to base it on expected or incurred losses. And this is not just an academic debate. It's a far more important one because it materially affects the assessment of asset quality and valuation, which of course in turn informs investors and regulators about the institution's financial strength. So, capital and liquidity, accounting rules. Third item on which clearly regulatory efforts has to be made is the too big to fail issue and the resolution. The FSB led the initial progress and came out with clear guidelines in that respect, and the United States and the United Kingdom moved forward, followed through, and coordinated contingency plans when winding down failing cross-border banks. But some banks, notwithstanding those efforts, and bearing in mind that continental Europe has not moved as efficiently, although regulation is in the making, notwithstanding, some banks are still regarded as too important to fail due to their size, due to their complexity, due to their interconnectedness around the globe. And this is not right. It is not right because there is an implicit subsidy that is attached to that principle of too big to fail. And there are multiple ways of calculating that implied subsidies. The IMF estimates that this implicit subsidy that is available to banks, those too important to fail, in terms of lower borrowing costs, is at around 0.8 percentage points. Other people have used this to derive a dollar figure to the 5 largest banks in the United States of approximately $64 billion. Well, that's roughly their annual profit, which essentially is borne by the public, or the taxpayers, if you will. But it highlights the special dimension of the issue. Pressure to address the moral hazard from this problem and facilitate resolution has fostered the development of regional initiatives here and there, whether it's the Liikanen proposals, the Vickers report, the Volcker proposal, or legislations in the making at the moment in both France and Germany. All of them are heading in that direction. And while very well intentioned, because of their fragmentation in many ways, they expose the system to the risk of lack of coordination and, as a result, potential arbitrage. So the bottom line is that despite the efforts that have been undertaken, the problem of the too big to fail still needs to be completely addressed. And in our view, we need to forge ahead on 3 fronts: regulation, like systemic surcharges, however, not like they are by the industry; intensive and competent supervision in order to anticipate and prevent. And I was delighted to see that Germany has decided to have a special council actually focusing on those issues, which was, I understand, opened formally yesterday. And frameworks for orderly failure and resolution nationally and cross borders. And, to the point of who does it apply to? It applies to all those that are systemically important, whether in large or in small countries, relative to the size of the GDP to which they apply and relative to the interconnections that they have networked or weaved around them. In the coming months, jurisdictions need to spell out plans to resolve each systemic institution, as I said, regardless of its size, interconnectedness and complexity. And in addition to cross-border collaboration arrangements, this will require an ability to impose discipline on the managers, discipline on the shareholders, discipline on the junior bondholders, and of all such large failed banks, using bridge banks and other resolution tools to preserve the liquidity of borrowers, depositors, and other counterparties. 4th item on my list of regulatory issues and reforms that need to be improved and progressed: derivative markets. Reforms on that front is clearly too slow. We all agree that wider use of clearinghouses will raise transparency of over-the-counter markets and make the system safer. However, and that was one of the goals of the G20 leaders way back at the Toronto summit, I recall it very well, none of the authorities have actually met the deadlines to implement reforms. 2 points on that. First of all, available data shows that the increase in the value of centrally cleared contracts has been modest since that commitment. It's only increased by 10%. Now, one might argue that the overall trade in that particular market has declined. Not sure about that. We don't have certainly the evidence to demonstrate it. Why? Because second, the data is very limited, and that is particularly true in relation to commodities, in relation to equity and foreign exchange asset classes. And it's a problem that needs to be addressed. You know, if we thought, well, it's okay, you know, we can live with it. Clearly, the latest discussions about what happened at JP Morgan and the 6 billion loss caused by the whales, the London whale incident, let's call it that way, is an indication of how sophisticated, how complex, how difficult it is to actually handle those risks, and our risk managers on that particular occasion just couldn't grapple with the complexity of the issue. Now, I've got 2 more to go on my regulatory list. The next one is shadow banking. Again, let me backtrack to the G20 commitments. Back in 2009, Toronto meeting, again. No, I think it was the London G20 meeting, actually, not the Toronto meeting. So it was earlier than that. There was a commitment by the leaders of the G20 countries that no market, no product, no operator, trader, if you will be without regulation, without supervision. Well, when we look at the shadow banking, I'm not sure that we have much progress to report. And this is worrisome, since regulators were largely in the dark before the crisis, and probably since then as well. I have very vivid recollections of the anxiety of the appropriate authorities in the US in particular about the size, extent, connections, counterparties, and where they were located when the Lehman decision was taken. And it's probably the case that as the banking sector as a whole has reduced in size, some of those funds have been migrating to new unregulated activities. And we certainly have anecdotal evidence, only anecdotal evidence, because there's no official data in that regard, that trading is moving to unregulated hedge funds. Now, let me turn to compensation. Those who know me will probably remember that when France was head of the G20, we pushed that particular item actively. And I have to say that in that respect, Philipp Hildebrand, who was the former head of the Central Bank of Switzerland, was extremely helpful and active in trying to gear everyone in the direction of bringing a bit of sanity in the field of compensation. And I was very pleased to read under Mark Carney's signatures that, and I'm quoting him, an important lesson from the crisis was that compensation schemes encouraged individuals to take on too much long-term risks and tail risk. Now that's a difficulty for human resources and remuneration designers going forward, because what do? Do you actually compensate highly and generously those people who do not take risks? That's a bit strange. At the other end of the spectrum, do you compensate heavily and generously, exponentially, those who take very high risks, for which very high rewards are associated? Certainly not, because that clearly came as a mistake. So where is the trick? You know, clearly we don't have the answer for that, but there must be an element of curbing the incentive trend as risks exceed a certain level or are not properly addressed and measured. And that needs to be done because the financial sector, for its specificities, has a duty to live up to the highest ethical standards. And if ethical standards were not enough, the issue of reputation, of appreciation of the very good work that is done by bankers is currently an issue. And, you know, suffice to just look at some of the surveys and polls and opinions about our sector indicates that it's a worthy consideration. To that end, the FSB has forged consensus on compensation practice some time ago, and we fully support these principles and encourage all jurisdictions to actually follow them. I know it was heavily discussed on the European scene, and the European Parliament has made some headways in that regard, and you know, it will be for Europeans to actually endorse them and move on. But as far as we're concerned, the FSB consensus is perfectly appropriate. Now, how has that sort of impacted Europe and the European economy? Well, these reforms have certainly had an impact on the markets, and it has helped calm markets down, certainly for a given period of time. That, together with a central bank in the Eurozone, which has had to take some fairly aggressive decisions and use some fairly innovative tools in order to actually make sure that there is proper monetary transmission to the real economy sector. Can we say that that has completely benefited households and SMEs and that they have actually had the benefit of this risk reduction, this improved discipline, and this path towards more cooperation, better convergence? If you ask SMEs in your city, in your region where you live, they'll probably say no. And if you ask households, they'll probably say no. So more remains to be done. Now, to fix this, I'm going to dare actually talk about balance sheet repair and banking union. And I will indeed focus a little bit on Europe. There is a lot to be said about other markets as well, whether it's the better coordination of regulators and supervisors in the United States, whether it's the monetary policy in other parts of the world. But given that we are here sitting in Frankfurt, I thought I would focus a bit on Europe. And I would like to talk about the chicken and egg issue that we see. Because it is possible that delays in agreement on regulatory reforms actually reduced the drive to deal with needed balance sheet repair and bank resolution, where there is still work to be done. But maybe it is that insufficient balance sheet repair acted as a brake on reform progress. And that's a bit of the chicken and egg situation that can either be addressed by trying to tackle the two at the same time in parallel, if you will, or addressing one before the other. And it's a difficult dilemma to resolve, actually, because you're not too sure which one is the chicken, which one is the egg. But I think we need to move beyond that situation and actually tackle both balance sheet repair and regulatory reform in parallel. It is essential to get credit flowing in support of recovery and to make sure that banks have actually a financial position and a financial strength to respond to that demand. Again, I'm not denying that there has been significant progress. US and European banks have substantially increased their capital ratios. And it goes a bit unnoticed. Those that participate in the process know about it. But between 2007 and 2012, the number of credit institutions in Europe declined by approximately 5%. Why? Because 20 banks were resolved. 20 banks were resolved. I hear quite often that the Europeans don't know how to resolve banks. Well, it had to happen in various places. And in addition to that, 60 banks have undergone deep restructuring in many countries of Europe. But again, more needs to be done. Many banks are still shackled by the leftover effects of the crisis, and it's a bit, in our view, of the weak link in the recovery. We still see fragmentation in funding conditions, direct result of a concern about the quality of bank assets, which is impairing the credit transmission to the real economy. In addition, peripheral euro area banking systems remain relatively weak, with capital buffers still low relative to impaired assets. As a result, these banks are less capable of absorbing loss, which worsens the drag on new lending. And you have this sort of vicious circle from which it is difficult to extract oneself unless very serious measures are taken to actually right-size and right-value the balance sheets of banks. Added to which, cleaning up of the balance sheet, a common backstop should also be available, which is the European Stability Mechanism for systemic cases. Enhanced disclosure and credible asset quality reviews will help restore confidence, and banks should be urged to deleverage by raising equity and cutting those business lines that are no longer viable. Country authorities and the single supervisory mechanism should undertake selective asset quality reviews. Now, for direct recapitalization by the ESM, which is, I know, controversial issues, both in terms of sequencing and in terms of actually substance, modalities and governance arrangements should be established as soon as possible. There's nothing, you all know that. I've been in business, you've been in business, you're in business. Uncertainty is a drag. And everybody will want to know what the ESM is capable of doing, when it can intervene, how, in relation to which targets. So, what about banking union? Yes, I wanted to talk about that as well, and that will be my last topic. Because it is part of the bigger picture. Full banking union in Europe. But what do we exactly mean by banking union? Buzzword. What's underneath? Well, from our point of view, it means single supervisory and regulatory framework. That's very advanced already, not yet there, with the timetable. A single resolution mechanism and resolution authority, not there yet. A common safety net that includes deposit insurance and lender of last resort capabilities. And as I said, I think that current developments actually do not point in the direction of forget about it, not an interesting project and not one that should be pursued. I think quite to the contrary. It shows the urgency of moving forward. This integrated oversight framework is the logical extension of an integrated banking system, and there is no question that we have an integrated banking system in Europe. I was looking at the list of participants, and it's there. A lot of French banks are in Germany, a lot of German banks are in France, a lot of European banks are just mingling with each other and in each other's territories, so to speak, in the old Westphalia Treaty sense. Banking Union will move responsibility for supervision and potential financial support to a shared level, which would help contain systemic risks and curb moral hazard. This would also remove destructive incentives for deposit flight and fragmentation, and it would weaken the vicious loop of rising sovereign and bank borrowing crisis. Now, we just recently released 2 important papers, one of which actually is the inaugural Financial System Stability Assessment for the European Union. We had never done it before. It was published, I think, last Friday. It's full of really interesting findings that I'm not sure that you will enjoy the reading of it, but at least we're trying. Having said that, it's not all gloom, and there are some very, very positive steps that have been taken. Let me just mention a few of them. The agreement on the single supervisory mechanism. The proposals only yet, by the European Commission to harmonize regulations on capital requirement and on the Capital Requirement Directive, the CRR and the CRD4. On resolution regimes and for national deposit insurance schemes. Those are proposals. Third, agreement to draw on the ESM to recapitalize banks with ECB supervisions and with conditionalities. And finally, commitment to a single resolution mechanism with backstop arrangements to recoup taxpayers' support over time. Solid principles, good proposals. But there is a to-do list which includes at the top follow through, because that will be critical. It means swift adoption of the various directives and ensuring that they are in full compliance with the global accords that you know of, whether it's Basel III or whether it's the FSB key attributes. Other priorities include endowing the single supervisor with the requisite resources and authority. I'm pleased to see that there is a lot of hiring going on in Frankfurt at the moment on that front. implementing the common resolution and safety nets with a coherent, credible backstop, and setting up the resolution authority and insurance fund with access to common backstop. Those will be needed in order to actually deliver on the promise that was made of a currency zone, of a banking union, one day of a fiscal union, and a political union. And that will actually, hopefully, help sever the link between sovereign and banks, which is clearly what I call a loop-de-loop, which is causing great difficulties for both banks and sovereigns, because they sort of help each other in many ways and in difficult circumstances, as a result of which they weigh on each other. So let me conclude. I asked earlier if the financial landscape has been transformed. A lot of work has been done. Work is not completed yet. And I don't know, if you're comparing with a construction site in a way, mostly the wiring and the plumbing, which are essential elements of a solid structure, but under the surface, needs to be completed. The structure is still half built and it's still half safe. So completion is in order. Weak banks are still a drag on growth. Balance sheet repair needs to be tackled at the same time as regulatory reform in a mutually reinforcing manner. Finishing the business in both areas is necessary to re-up the fruit of hard-won improvement in regulatory reform and to restore the full functioning of the financial sector so that it can do its job and be that good intermediating structure between lenders and borrowers in order to support growth. I'm an optimist. Actually, the difference between the optimist and the pessimist is nil, because they both get it wrong, but the optimist is a bit happier. So, being one of those, and drawing inspiration from Martin Luther, he said something like, it's translated into English, I'm afraid, everything that is done in the world is done by hope. So we have to hope, we have to believe that progress can be made and that there will be improvement to the banking sector. But I'm also a realist, and borrowing from your great philosopher Kant, he said this, and I'm quoting again from an English translation for which I apologize. Using reason without applying it to experience only leads to theoretical illusions. And I would finish with the need for actually all parties involved, the industry, the supervisors, the regulators, to actually work cooperatively with a view to protecting the common good, not necessarily the vested interest that matter at one point in time. Because if this larger interest is not foreseen and defended, then the vested interest will really not matter in the long run. Thank you very much.